But that'll come too. But make no mistake, we're in a go bull market. I've seen these before. And visualize this bull market, Shay, as a circus master's whip. The handle of the whip, the front of the whip moves first. That's gold. That has to precede. The next thing that goes past the circus master's shoulder are the Franco Nevadas, the biggest, the highest quality companies in the world. They move next, pulled by gold. Then the best of the rest move. Then the developers move. Then the penny dreadfuls move. This follows a predictable pattern. With each stage of the whip, when they move faster and they move further. But the whip moves qualitatively. We're now in the part of the whip that favors the Wheaton Precious, the Franco Nevadas, the Agnico Eagles, those guys, the best of the best. But the move will come very quickly to the best of the rest.
What if I told you that the U.S. government owes nearly 93% of America's entire private wealth? What if I told you that we're staring down a $36.2 trillion crisis that can only be solved by destroying the dollar's purchasing power? And what if I told you that despite these apocalyptic numbers, we might be witnessing the most explosive opportunity in gold's modern history? For years, gold investors have been told the same story: unsustainable debt, currency debasement, and a looming crisis that should send prices to the moon. Yet many have grown frustrated watching gold trade sideways, wondering when, if ever, the breakout would finally happen. Sound familiar? Well, that frustration might finally be over. Because right now, a combination of factors is aligning that could create the most explosive moment for gold in decades. Central banks accumulating gold at unprecedented rates, precious metals allocation sitting at historic lows, and a mathematical debt crisis that has only one historical solution. But here's what makes this different from every other gold is going to explode story you've heard. This time, it's already happening. Gold is breaking records while stock markets soar, real estate holds strong, and crypto maintains its ground. This isn't supposed to happen, yet it is. So what's really driving this unprecedented rally? What will be the trigger that sends gold into true crisis mode? And more importantly, how high can it actually go? Today, we are exploring the gold market with Rick Rule, founder of Rule Investment Media and a natural resources expert. He is one of the most respected voices in precious metals investing. His analysis will show you exactly why this bull market is just getting started, what's driving the unprecedented institutional buying, and why the smart money is positioning now for what could be the wealth transfer of a lifetime. Don't forget to like, share, subscribe, and leave a comment. Thank you.
Absolutely the person to have that conversation with. And I think we're going to have to start with the elephant in the room, or maybe the bull in the room, and that is gold. Rick, it has been on one hell of a run in the past 12 months. The questions I'm hearing is, can it keep this momentum, or have we missed the boat?
That's a great question, Shane. I think it depends on who you are. You and I might remember conversations we had in 2023 when people are saying, when's gold going to move? Those people who were buying gold because it was oversold and it would come back should sell. You know, if you owned gold for a trade, you got your trade. Kiss it, move on. That's not why I own gold. I own gold because I have a sense of history. I own gold because gold has done well when people are concerned about the maintenance of their purchasing power in fiat-denominated instruments. And I think that fear is just getting started. I can't talk to you about Australian math, but let me give you some American math. The on-balance sheet liabilities of the U.S. government exceed 36 trillion U.S. dollars, not Australian dollars, U.S. dollars. But the off-balance sheet liabilities are even worse. What are off-balance sheet liabilities? They're old guys like me. Medicare, Medicaid, Social Security, federal government pensions, military pensions. That number, the net present value of that number, is $100 trillion. The American Internal Revenue Service estimates that the private net worth of Americans is $141 trillion, and our government owes 130 of it. This is a lousy number, Shay. I mean, this is a really lousy number. I believe that we deal with that debt rather than honestly by defaulting dishonestly. In particular, I think that we do what we did in the 1970s, which is to say that we devalue the purchasing power of the US dollar. You honor the nominal value of the obligation. You say to some old kook, Rick Rule, we promised you $4,000 a month in Social Security, and you're going to get it. But we're going to devalue the dollar so that the $4,000 buys you $1,000 worth of goods and services. In the 1970s, according to the Congressional Budget Office, the US dollar lost 75% of its purchasing power. That's how we dealt with the debt built up by the war in Vietnam, which, by the way, we lost, and the war on poverty, which, by the way, we lost. My suspicion is over the next 10 years, the purchasing power of the US dollar declines by 75%. In the 1970s, when we devalued the US dollar by 75%, the gold price ran 30-fold. I'm not suggesting to you that gold runs 30-fold from here, but I am suggesting to you that there is a probability that gold's rise keeps pace with the decline in purchasing power of the US dollar. That's a pretty attractive proposition, Shay. People ask me, well, Rick, you've been bullish on gold for at least 5 years. What would make you sell? That one's easy too. If the reason to own something goes away, the thing has to go away. So they would need to balance the US budget. They would need to have positive interest rates in the US. By positive interest rates, I mean that the interest on the US 10-year Treasury would have to be larger than the deterioration in the purchasing power of the US dollar. And they would have to have a fiscal plan in place to deal with $100 trillion in the net present value of government liabilities. I suspect 10 or 12 years from now we'll get there. But I don't suspect in 2 or 3 years that we'll get there. And I'll give you one more piece of really cool math. JP Morgan Chase suggests that the market share of precious metals and precious metals related assets relative to other asset classes in the US savings and investment market is 0.5%, which is to say, if you look at every investment and savings asset class in the United States, only 0.5% of our total portfolio is denominated in precious metals. JP Morgan Chase says that the 4-decade mean market share is 2%. If negative real interest rates and debts and deficits begin to concern people the way they concerned people in 1971, 1972, if gold was to return to mean, that would give you a 4-fold increase in demand. I can't tell you what that would do to price, but I can tell you that the number is much likely to be higher than lower. So I am and remain a gold bug.
What I'm essentially hearing, Rick, is aside from some terrifyingly scary numbers that I'm pretty sure would take me a long time to write out, is that you're telling people to be patient when a lot of people have learned to embrace volatility looking for short-term gains. And you're telling that gold is about the long game.
Well, you brought up a very different topic, Shay, one which I thought I should have thought to bring up. As you know, I've graded tens of thousands of portfolios in the last 25 years for free. And although I've taught a lot, I've learned a lot too. I've learned that most investors make 3 mistakes. They buy stuff that's hot rather than stuff that's not, which is to say they overpay. The second thing that investors do is they own too many stocks. They own way more stocks than they can possibly keep track of. But the most important single mistake that people make, the most important mistake is most investors that I know get the long-term strategy right, but their tactics are short-term. Somebody believes that gold is going to do well over 5 years, but their anticipated holding is over the next long weekend. If you don't synchronize your expectation to the time that it will take for your expectation to play out, you're going to lose. Long-term strategy with short-term tactics does not intersect. The great American mutual fund group, Fidelity, with millions of investors, looked at their whole investor database and they stratified them by various factors. Uh, Zip code, net worth, race, gender, age, all this kind of stuff to try to figure out how to market to various groups, but also to try to figure out what various groups did right and did wrong. The subgroup that they came up with that outperformed every other investment class was dead people. Estates outperformed other investors because estates didn't trade. They didn't go from hot sector to hot sector. It teaches us a lot. If dead people can outperform active money managers, it tells you a lot about the right holding period for good investments.
So what's the solution to this alarming debt crisis? Rick believes we deal with that debt by defaulting dishonestly. He thinks we follow the same template we did in the 1970s by devaluing the purchasing power of the US dollar. In the 1970s, the dollar lost 75% of its purchasing power. He suspects that over the next 10 years, the purchasing power of the dollar declines by 75%, leading to a corresponding increase in value in gold. Now here's where it gets interesting. When the dollar lost 75% of its purchasing power in the 1970s, gold ran 30-fold. Rick isn't predicting gold runs 30-fold from here, but he is suggesting there's a high probability that gold keeps pace with the decline in the dollar's purchasing power. But the debt crisis is just one piece of the puzzle. The allocation story is equally compelling. JP Morgan Chase suggests that the market share of precious metals in the U.S. savings and investment market is 0.5%, half of 1%. The 4-decade mean is 2%. If gold was to return to its historical mean allocation, that would give you a 4-fold increase in demand. Let's let that sit for a moment. Americans are holding the lowest allocation to precious metals in decades, right when the fundamental case is strongest. When this allocation normalizes, and it will, the demand explosion will be unlike anything we've seen. Now, Rick isn't just bullish on gold because of the debt crisis or allocation opportunity. He's bullish because he understands market cycles, and he knows exactly where we are in the precious metals cycle. Let's get back to the video.
Absolutely, Rip. We're going to see a bull market that's reminiscent of the bull market that we enjoyed in the early part of the decade of the 90s. You weren't there, Shay, but take it from me. It was a lot of fun. Bull markets follow predictable patterns. The market is led by the commodity. We saw that in 2023 in gold. Gold led, but the gold stocks went nowhere. That's easy to understand. The buyers were foreign central banks, and they don't buy shares, right? So the asset class that had a buyer went up, and the asset class that didn't have a buyer didn't go up. Surprise, surprise. But that follows an age-old pattern because gold bull markets are led by fear buyers, and fear buyers don't buy stock. They buy the gold. Two things happen when gold itself establishes the momentum. The first is that the momentum of gold reinforces the gold narrative and makes the whole sector around gold more interesting. The second thing that happens is that the increase in gold price, once it gets underway, is faster than the increase in the input cost to produce the gold. So the biggest and the best producers, the seniors, start to deliver absolutely blowout earnings, which is what we saw in 2024 in the gold sector. Gold mining company managements exceeded even their own optimistic performances about their quarters. And the investors were newly conditioned to that by the increase in the gold price. So we saw just 15 weeks ago investor interest, retail investor interest, storm back into the gold ETFs after having been absent for 3 years. This has happened in every bull market of my life. When that happens, the senior producers, the largest, the most liquid, the highest quality producers, develop valuation disparities. They get the buyers, and in particular, they get the index and passive buyers. And so their share prices relative to their net asset values grow. While the best of the rest, the other producers, don't participate. Then one of two things happens. The relative value guys, the Rick Rules of the world, say, well, this class is cheaper than this class that's already moved. So I got to shift some of my dough from up here to down here. If that doesn't happen, the big guys take over the little guys because their cost of capital is lower. This is simple stuff. After that happened, the single asset producers and the best of the rest move for the same reason, valuation discrepancies. And then finally, the juniors and developers move. These follow predictable patterns. This will happen again. There is a bull market coming to a sector near you. In fact, we're in it. I don't think that we're in an industrial materials bull market yet. I think that market is hampered by the specter, perhaps real, of a worldwide recession. I wouldn't look for relief in nickel or copper or oil and gas in the near term, but that'll come too. But make no mistake, we're in a go bull market. I've seen these before, and visualize this bull market, Shay, as a circus master's whip. The handle of the whip, the front of the whip moves first. That's gold. That has to precede. The next thing that goes past the circus master's shoulder are the Franco-Nevadas, the biggest, the highest quality companies in the world. They move next, pulled by gold. Then the best of the rest move. Then the developers move. Then the penny dreadfuls move. This follows a predictable pattern. With each stage of the whip, when they move faster and they move further. But the whip moves qualitatively. We're now in the part of the whip that favors the Wheaton Precious, the Franco-Nevadas, the Agnico Eagles, those guys, the best of the best. But the move will come very quickly to the best of the rest.
Let's break down what we've learned today. First, we're facing a mathematical impossibility. The U.S. government owes $36.2 trillion in debt. The only historical solution is currency debasement, and when that happened in the 1970s, gold rose 30-fold. Second, Americans are holding their lowest allocation to precious metals in decades, just 0.5% versus a historical average of 2%. When this normalizes, we're looking at a potential fourfold increase in demand. Third, we're already in a confirmed precious metals bull market, and according to Rick Rule's analysis, we're still in the early stages. The institutional money is flowing in, the technical patterns are textbook, and the fundamental drivers are stronger than ever. But here's the key takeaway. This isn't about timing the market or making a quick trade. This is about understanding that we're living through a monetary crisis that will reshape wealth for generations. Smart money is positioning now, not because they think gold might go up, but because they understand that in a world of currency debasement, gold isn't just an investment, it's financial insurance. Rick Rule has been doing this for over 40 years, and he's saying the setup today is as compelling as anything he's ever seen. The debt crisis, the allocation opportunity, the institutional awakening, it's all converging at once. So what's your take? Are we in the early stages of a historic gold bull market? Or do you think we're due for a correction before the real move begins? Let me know in the comments below. And if you found this analysis valuable, make sure to subscribe and hit that notification bell so you don't miss any of our precious metals analysis. Thanks for watching, and I'll see you in the next video. Remember, in times of monetary crisis, gold isn't just an investment, it's survival.